Economic collapse approaches, but first, euphoria. Hi, everyone, and welcome to Ainslie Insights, brought to you by Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard as the Ainslie Group celebrates 50 years. Today, we welcome back Dhruv, who's been putting all the pieces of the macroeconomic puzzle together to show us where we're likely heading next in a great article today. I really enjoyed it. How are you going, Dhruv?
Good, Chris. Thanks for having me back on.
Thanks for coming back on. That article, like I said, was really good. It sort of pulled together a number of things that you've been talking about, that we've been talking about. I found it really quite good at piecing all those bits together. To start us off today, I wanted to talk about one particular thing you mentioned, which was this wall of worry. And it seems like it's a term we've heard before, and I'll get you to explain it, but it seems like that explains quite well what's going on at the moment, where everyone is pretty negative, and certainly the sentiment I seem to be reading in my feeds is quite negative, but the price keeps going up. Is that what's going on with the wall of worry?
Yeah, absolutely. So the wall of worry is a very interesting time. It's something that you really want to get ahead of as an investor. Waiting till we're over the wall of worry usually means that the train has left the station and you're scrambling to board a moving train in a sense. The wall of worry is the phase where you'll have plenty of buying opportunities if you're looking at the bigger picture and you've got a thesis that you're confident in. What it essentially is the recovery phase from the previous bear market, where we are moving through the resistance levels of the bear market from a price perspective. So you're climbing the price through that price range, and there are a whole bunch of economic issues going on in the background, and they're all valid, they're all real issues, but they don't actually affect the price because the price is moving up as a result of liquidity entering the system. So all of these economic issues cause fears and panics, and they do cause volatility in the short term in price, but the macro trend is up because of larger factors at play, which are unaffected by these little events. And um, there's a common expression that basically says that, bad news will affect price in a bear market, and good news will affect price in a bull market. But bad news doesn't really affect the price in a bull market, and vice versa. So I think paying too much attention to the news gets a lot of people caught up in this wall of worry, versus just fine tuning your news sources to a few reliable ones will help you not get caught up in that noise.
And that is really tricky to do. And we face that even here every day because we're looking at things, we speak to different people, we're looking at it through different lenses all the time. And you need to try and piece that together to form a narrative and a explanation that makes sense to you personally. It is a tricky one to do. So that's probably why I appreciate so much that article today, because it really did pull a number of these threads together and made sense for me at least. I wanted to go down a slightly different angle with the next question and talk about bond yields, because that was something that seems to tie in with what you just said. And it was another part of the puzzle. You were talking about we're expecting these interest rate cuts. Like it seems globally that's the world we're heading into. It seems pretty much a certainty now with the US probably later this month. That will push that liquidity that you were talking about into the system. Can you maybe explain that a little bit, go into a little bit more depth on that, and particularly how it's going to impact things like asset prices, gold, land, stocks? This is what we're ultimately expecting to be buoyed by this.
Yeah, the bond markets are really really worth paying attention to. I think they're the largest financial markets in the world, probably quote unquote the smartest money that's generally moving the markets, are participating in the bond markets. Now, to give really like an overview, not to get too caught up in the detail, but with the bond markets, what you see is bond yields fall. So the return that you're getting on your bonds will reduce from a percentage term. And what that results is in the bond value going up. The reason for that is if you're getting a lower yield on something now than you were on the same product recently, the product where you were getting a higher yield is now worth more. So the secondary markets where people are trading bonds, the 5% bond will be worth more than the future bonds, which are going down in value in terms of the return, the fixed interest that you get on those. So with bond returns and bond going down, yields and bonds going down, bond values go up, and that increases the bond value holdings, which is the collateral for most banks. By legislation, they have to hold a pretty large amount of US government bonds. And when your collateral values increase, your balance sheets look a lot better. you can create a lot more debt, you can issue a lot more debt, and that floods liquidity into the system. The other thing that's interesting about the bond markets is they usually front run the central bank's interest rate policy, because they're able to, the central banks, the US Fed is famously late to act, versus the participants of the bond markets tend to be calling the Fed's bluffs early on, looking at a whole range of economic indicators, and sort of guessing the Fed's moves before they let their moves onto the public through their various speeches and addresses that most people are paying attention to. So the bond markets are usually one step ahead. Now, what we've seen is the bond yields have been dropping pretty consistently since October. And the US Fed has only recently, since October of 2023, and the US Fed's only recently started talking about reducing interest rates. So, for that trend of the US bond yields to be set in place as a downtrend, I mean, you've got to see a high, a low, a lower high, and a lower low on a large time frame, which has only recently really been established, with the lower low on the weekly just being set in. So you can see a clear downtrend in the US bond yields, which gives us a lot of confidence that interest rates will follow. Now, interest rates reducing again will further inject liquidity into the system, because people are getting lower yields on US dollar deposits, so they'll move their liquidity elsewhere to gain yield from somewhere else. Beyond that, you also see other things like borrowers can borrow more on a lower interest rate, and then that injects liquidity into the system as well. So there is a bit of a domino effect at play. But to simplify it, low bond yields means high bond values, means low interest rates, means more liquidity, means number go up.
And specifically, when you're thinking about gold, land, stocks, all those assets, that's the mechanism I can see there, because you've got, if they're not getting that yield that they were getting on the bonds, then all of a sudden it makes sense to go and put it into other things that would be potentially number go up, like you just said, like gold in that example.
Spot on. That's definitely a function of looking for yield elsewhere. It's also a function of liquidity entering the system. So more dollars that enter the system, they have to find a home. And
yes.
while that leads to inflation, which is asset inflation and consumer inflation. Now, there's usually about an 18-month lag before you start seeing the consumer inflation come in at the grocery store. But the asset inflation almost happens in real time. These dollars need to find a place to live, and they're going to find it in gold, in land, and in stocks, various other assets. The other point as well is when you increase the supply of the dollar and you have inflation, you're reducing the value of the individual dollar units as well. So anything priced in dollars like land, US land, gold, and Bitcoin globally, which are global assets that are priced in US dollars, will increase in value just because of that ratio as well. So there's a few different factors at play, but generally what this leads to is a fairly exponential increase in asset valuations, and then that further drives speculation. Then that there's the emotions behind investors all jumping on at the same time, everyone trying to board a moving train all at once, and then that further drives exponential price increase. So there is definitely a domino effect that takes place.
And this all ties in as well to this 18.6-year economic cycle. You wrote an excellent article about this last week, the week before. It was fairly recent, and people should definitely go back and read that if they haven't already, and watch the insights we did on it as well. But that's, you can see all of that coming in when you zoom out and look at that much, much bigger picture that fuels that next leg that you were talking about there, which includes this parabolic asset price run that potentially comes before we see the big crash. And I think that was effectively the meaning behind the title of today's article, that, first a crash is coming. You're not saying it's not coming, but first we get that big parabolic move. Is that, am I getting that correct? Is that the connection there between what you've just been talking about and your longer term thesis around the 18.6-year cycle?
Spot on. I mean, this cycle repeats, every 20 years over and over again in the same fashion. And the phase that we're in now for the 18.6-year cycle is essentially the second half of the uptrend. And even beyond that, we're in the latter half of that second half of the uptrend. So it really is the final phase of the uptrend in that 18.6-year cycle. That's typical of assets moving up rather than being a function of productivity, being a function of liquidity, leverage, speculation, emotion, euphoria, and things getting overvalued, unsustainably so, And that's eventually what leads into the collapse. It's not when everybody's looking for a collapse and too afraid to invest in the markets. It's when everyone has no choice but to invest in the market because they feel like a bit of a fool for not investing in something that's just been going up and up and up exponentially. And when they make that decision based on emotions, at that point, it's usually in the final stages of those cycles. And they get a little bit of further price increase before everything is so overheated, and then they've got to go through a collapse. So it is quite a dicey phase of the cycle.
And it takes place over such a long time that it can be hard for people to get their head around that, because 20 years is a long time, right? Like, you think about that. So you do need to understand where you are in that cycle, because you forget that if there is a bigger cycle at play and you just live in the moment, and you just think this is how it always is, when really it explains a lot. I just thought it was a really great thesis, and people do need to get their head around it. Um, Turning to gold specifically, and how that fits into everything you've been describing here, including that last blow off top phase that you get in that larger term cycle. You referred to it as God's money, and I thought that was a really interesting way to refer to it, because it does really perform well during that boom, but also during the crash that follows. Do you want to maybe talk to us a little bit about gold through that cycle? Because I imagine that's really its key role that it can play in an investor's portfolio.
Absolutely. So during the crash phase, people are looking for safe haven assets. That's the US dollar, usually assets like gold and silver as well.
Hmm.
During the previous phase, just before the crash, when liquidity is all over the place, we've got a flood of liquidity and leverage. People are looking for growth assets, not safe haven assets, and assets that benefit from exponential liquidity. Gold just happens to be both. So the US dollar is not going to do well when liquidity is increasing because of the inflation, which results in reduced valuation of the individual dollar units. It's going to do well during the collapse, or at least recover during the collapse. Gold is going to do really well during the euphoric phase because it's priced in US dollars, because there's more liquidity, because those dollars need a home, all those things that we've just discussed. Gold will increase in value because of the supply demand dynamics. But then in the crash that follows, gold will continue increasing in demand because people are looking for a decentralized, safe haven, eternal asset that isn't affected by systemic failures, because that's what's really prevalent in that final phase of the collapse. It's not just a correction in the markets. You see broad-based financial systemic failures. And when people are concerned about banks going down, hedge funds collapsing, pensions collapsing, they're really just looking for something that is safe. So the US dollar does recover, but it doesn't do exceptionally well. Gold and silver in those environments do exceptionally well. So it's really one of those things where if you're looking for shelter from the storm, gold's good. If you're looking for liquidity, taking advantage of liquidity in a growth asset, gold is good there as well.
And I like, probably my last follow-up question on that is the magnitude that you're talking about for this potential crash that comes is probably in the order of magnitude of the 2008 financial crisis. That would make sense to me. It's also about that 20 years ago. It would fit nicely in terms of that timing. Not that we're saying that's now, but what's coming sort of up soon. So
yeah, I would actually argue that it's probably going to be bigger than the 2008 financial crisis.
Right.
The reason I say that is since the 2008 financial crisis, the way they've repaired that was through just creating a facade of a healthy economy and recovery, but they've actually made the systemic problems worse.
Yes.
And what happens with 20-year cycles, from my observation, is you see 4 to 5 20-year cycles build on one another to really create the macro 80 to 100-year cycle. And so what I'm looking at coming up next is similar to the Great Depression rather than the GFC. So I would look at, a systemic issue that's been building over multiple 20-year cycles, actually resolving by the end of this decade. So it should be definitely a time to watch things carefully. Certainly no need to get caught up in fear, because that is part of the problem, is people getting caught up in emotions. But diversifying assets, being humble, not getting caught up in emotions, and just realizing that safe haven assets like gold and silver will give you that yield, but at the same time give you that protection. I think that's a fairly simple way to play that situation.
Yeah, and that's fantastic, because I think that's really, like you said, it's not about being fearful, but it's about being aware that that's the potential of what could be coming. And when you really look at, you just need to look at the deck charts for the US to go, okay, it's not, ridiculous to think that it's going to at some point fall collapse in on itself. I think a lot of people watching this will agree with that. So really valuable stuff. I once again thoroughly enjoyed that article today. You really pulled all those pieces together. So thank you for your deep dive on that, and linking it back to your previous work on the 18.6 year cycle as well. Really valuable, and I think everyone will enjoy it. So thank you for your work on that.
Thank you, Chris. Always great to chat to you. Talk to you soon.
Always good to talk to you. Thank you everyone for watching. We'll chat again soon.